Welcome back, everyone. I hope you're doing well. And in this video, we're going to take a look at the 6 big tech companies you should have on your watch list for the upcoming trading week. Earnings season is underway, and over the next few days, the largest companies in the world are sharing their latest quarterly results. And after a pandemic-ridden 2020 that sent the tech companies to the moon, investors all around the world are looking forward to finding out if that momentum can continue throughout 2021. And if you're new to the channel, this is a series where every single Sunday we discuss the major events taking place over the next few days, which include earnings reports, conferences, or product launches, and then discuss the companies who may be impacted from these events. And in this episode, we're going to focus on the market leaders who continue to grow and expand rapidly every single year. And before we take a look at that first company, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first big tech company you should have your eye on this week is ticker MSFT, which of course is Microsoft, the second largest company in the world, currently trading for $261, and over the trailing 12 months, they are up by 52%. They have a market cap at 1.97 trillion, trading with a forward PE of 35 and a slight dividend yield of 0.86%. And recently, the company's been making major headlines after they just acquired Nuance in a deal worth just under $20 billion, and this will help expand their speech recognition and artificial intelligence sector. And the company, over their latest report, just shared some major growth in their cloud network, and their Azure system grew 50% in revenue year over year, and the launch of their latest Xbox sent that content sales up 40% as well. So the company is coming off a very strong quarter, hoping to continue that over this latest report. And if we take a look at the analyst expectations, Microsoft's projected to bring in $40.85 billion of total revenue and earnings per share of $1.78. And over the past 90 days, analysts have only gotten more bullish on Microsoft, and we've seen 26 upward revisions in EPS expectations and 0 downgrades. And over the past 4 quarters, the company's beaten on guidance every single time, and going forward, to end their Q3 and Q4 of their 2021 fiscal year, we're expecting some major expansion in their total earnings quarter over quarter. And although the company does pay out a slight dividend, the yield is only at 0.86%. Their payout ratio of their net income is at a very low and very sustainable 30%, and their average dividend growth is at just below 10% per year. But this company also rewards its investors with tens of billions of dollars of share buybacks every single year as well. And if we take a look at their income statement, their growth has no signs of slowing down. Year over year, total revenue continues to expand with over $153 billion of total sales in the trailing 12 months. And of course, that is an all-time high. But what's incredibly impressive with Microsoft is at this number, they are extremely profitable and have a net income profit margin of 33%, which is absolutely amazing. So $51+ billion of total income over the trailing 12 months on $151 billion of total sales. And going forward, the company's projected to grow by over 18% per year over the next 5 years, and the current share price right now is below the 12-month price target, and analysts have this company as a strong buy, coming in with a 1.7. So of course, Microsoft does share their latest earnings on April 27th. I'm really looking forward to this report because this is the second largest company in my personal portfolio as well. And if the company shares some bad earnings and the stock continues to dip, I will gladly buy more even at this current level. And now if we continue on and take a look at the second big tech company included in this week's episode, we have ticker GOOGL, which of course is Alphabet, or Google's parent company. They currently trade for $2,300 per share, and over the past 12 months, they have expanded by 80%. And if you can't afford to buy one full share of Google for that $2,300 mark, most brokerages on the market right now offer fractional trading where you can invest as little as $1 and get a fractional share of Google, so it's still part of your portfolio. Right now, the company has a market cap at 1.55 trillion and have a forward PE of 33.46. And to close out 2020, Google shared some incredible growth over their previous earnings, and their cloud network grew 47% in revenue year over year. And that growth is projected to continue into 2021 as well. And Google also owns YouTube, which is a very powerful social media network that is only expanding at a rapid rate. And to close out 2020 as well, their total revenue in a 90-day span from YouTube was at $6.9 billion, which was up 46% year over year. And they're projecting that over the next 24 months, more people will watch YouTube every single month rather than cable and direct TV. And I think YouTube is extremely powerful. I think investors on the market right now are underestimating how big it can be over the long term. And because Google is their owner, one of the most powerful companies in the world, YouTube is going to be around forever. And I think growing a platform like YouTube will continue to grow naturally as time goes on and consumers shift away from the cable networks for their entertainment toward mobile and, on-demand services that YouTube provides. And if we take a look, they are sharing their earnings this week. We have a revenue estimate of $51.61 billion with earnings per share of $15.50, 14 upward revisions over the past 90 days, and only 2 downgrades. And over the previous 4 quarters, they missed once back in early 2020, but followed it up with 3 major EPS beats over the past 3 quarters. And going forward, we're expecting 57% year-over-year growth in their earnings, followed by another 52% in the second quarter of this year. And if we take a look at their income statement, this company has been growing total revenue at a massive rate as well. $182 billion of total sales in the trailing 12 months, and back in 2016, they had just over $90 billion. So in a 5-year span, they've more than doubled their total revenue, which is incredibly impressive. And going forward, over the next 5 years, analysts are expecting 17% annual share price appreciation, and even at this current level, the stock is below its 52-week price target and is considered a strong buy, coming in at a 1.7. So if you want to own the big tech players, definitely the first 2 companies we took a look at in Microsoft and Google are some great names to own in your portfolio. And now we're going to continue on into stock number 3, which is Visa, ticker V, currently trading for $230 per share, and the company's up 38% over the trailing 12 months, and the company has a market cap at $491 billion with a forward PE of 41.7 and a slight dividend yield of 0.56%. And this is the leader in the credit and debit card market. They make up more than 50% of the global space, and they dominate their respective industry. And going forward, Visa is a company I think will be very hard to disrupt. They're already the market leader. They've been there for years. And going forward, the services they provide in their current network is already so large and well established. I don't see any young companies in this industry coming and knocking them out of their leadership position. And although they do have some main competitors in Mastercard and American Express, Visa is still the leader and definitely a company to hold for the long term. And we can see over the past 5 years, they've given investors massive share price appreciation of 190%. And over the past decade, the stock is up more than 1,082% overall, which is incredibly impressive. And if we take a look, they report on April 27th after market close. We have a revenue estimate of $5.56 billion and a current EPS expectation of $1.27. And we can see that analysts are expecting a kind of bearish return on Visa, and they've downgraded their EPS expectation 24 times over the past 90 days. With travel being shut down and consumers spending more time at home, saving more money and not spending it, Visa has taken a slight hit over the trailing 12 months. But we can see over the past 4 quarters, they have beaten on expectations each and every time. But over this next report, analysts are actually projecting a decline in year-over-year EPS, but going forward after this latest quarter, we're expecting some mass expansion in the high double digits going forward throughout 2021 and into their 2022 fiscal year. And although it's very small, Visa does pay out a dividend with a current yield of 0.56%. Their payout ratio is only at 23% of their net income, so extremely low and very sustainable, and they grow that annual payment at an average of 19% per year over the past 5 years, which is absolutely amazing. And why investors like this company so much is because they operate in an industry with insanely high net income profit margins. And if we take a look at their income statement, over the trailing 12 months, $21.47 billion of total revenue, and their bottom line or their profits came in at $10.7 billion, which means Visa has a net income profit margin of 50%, which is incredibly high, and that makes this company very attractive to long-term investors. And we can see going forward, analysts are projecting 17.5% annual share price appreciation over the next 5 years, and this company is still considered a strong buy, coming in at a 1.8, and the $230 price tag at this current level is below the 12-month expectation of $250 per share. So Visa is definitely another company to take a look at. I own them in my personal portfolio as well. I currently have around 21 different shares with a market value of $4,800, and I love this company, and I will continue to hold long into the future. How do you not love a brand with growing revenue and net income every single year, a very low and sustainable dividend, amazing share price appreciation, they're the market leader, plus their net income profit margin is extremely high at 50%. All around great company, and if they share a bad quarter and the stock continues to fall, one of the big names I plan to buy more of over this upcoming week. And now if we move on and take a look at stock number 4, we have the largest company in the world in terms of market cap, which is Apple. They currently trade for $134 per share with a $2.25 trillion market cap, and they're up 95% over the trailing 12 months with a forward PE of 30 and a dividend yield of 0.61%. And the company just hosted their first product launch event of 2021, where they unveiled new iPad Pros, new colorful iMacs, AirTags, and a few more accessories. And I believe the colorful iMacs, which are now powered with Apple's very own M1 chip, will be a nice driver of total sales later on in the 2021 calendar year. I like the colorful idea, and I like the fact that it's priced right around the $1,500 mark, so it thinks that attractive level for many consumers looking for an upgrade from our new work from home environment. And with Apple, the future of their business is going to come from their subscription and service-based revenue, which hit a high to close out 2020 of $15.8 billion in quarterly revenue. And going forward, this service segment, which right now makes up only a small portion of their total top line, is projected to grow to be the leading part of Apple's overall ecosystem over the next 5 to 10 years. And analysts at Forbes are actually projecting that this service by 2025 will generate $50 billion of profits, not revenue, profits over the next 4 to 5 years. And I truly believe going forward that Apple's service revenue is going to completely change the game, let them maintain market leadership for long into the future, and although they're already worth over $2 trillion, I see no reason why this company can't continue to grow for long into the future as they continue to expand their business with all new types of subscription revenue, bringing in that monthly and quarterly consistent cash flow. And Apple is already the largest position in my portfolio. I own 101 shares with a market value of $13,566, and this is a company I plan to hold for the very long term. And they report earnings on April 28th with a revenue estimate of just under $77 billion and EPS of 99 cents. And over the past 4 quarters, the company is beating guidance every single time, and we're projecting a 54% growth rate year over year in their latest EPS. And although their dividend is small, similar to Visa and Mastercard, with a yield of only 0.61%, their annual payout is at 82 cents per share, and it only makes up 18% of their total net income, which is incredibly low, and they're averaging just under 10% annual dividend growth for the past 5 years. And going forward, they are projected to grow by 15% per year over the next 5 years in the future. The company is still below their 12-month price target, and they're currently ranked as a buy, coming in with a 2. So the largest company in the world, by no surprises, I'm sure everyone has an Apple product, and going forward, this brand I don't think is going anywhere and will still be a major player and a dominant role model to the overall market for long into the future. And now we're going to continue on and take a look at the 5th big tech company included in this week's episode. And of course, that is Facebook. Ticker FB, currently trading for $301 per share, and they're up 62% over the trailing 12 months. And I think Facebook is the big tech company that often gets overlooked when discussing the most powerful brands in the world. They have a market cap at $855 billion and are trading with a forward PE of only 26.7. And right now, the overall S&P 500 has a forward PE of around 24. So to buy Facebook with a forward PE ratio just slightly above the overall market, I think is actually a very good deal. Facebook has a strong history of outperforming the market, and I think going forward, the company will continue to outperform over the longer term. And we can see their next earnings are coming out on April 28th after market close. We have a revenue estimate of $23.7 billion with EPS of $2.36. And over the past 4 quarters, they've beaten on guidance all 4 times, with major expansion coming over the next 2 quarters and expected growth of 38% year over year. And if we take a look at their income statement, another brand with massive revenue growth from $27 billion of total sales 5 years ago, all the way up to close to $86 billion in the trailing 12 months. That's a rapid expansion. They've more than tripled their total revenue in only a 5-year timeline, which is absolutely amazing, and not many companies can do that when they're still operating at such a large scale. And with Facebook, they have over 2.7 billion monthly active users across all of their different platforms. 2.7 billion. The world's population is at over 7 billion, so a large percentage of our global population uses a Facebook product every single month, which is incredibly impressive. They have net income coming in at just under 30 billion over the trailing 12 months, and another company with a very high net income profit margin. And why I love Facebook is because on their balance sheet, they carry 0 long-term debt. 0. They're an incredibly healthy company, an amazing financial position, rapidly expanding revenue. They dominate on a global scale, and really, I don't see any other competitors dominating the social media world like Facebook is doing with their actual Facebook platform, with Instagram, with WhatsApp, and all their other services. And going forward, over the next 5 years, we're projecting 21.5% annual share price appreciation. The current level is below the 12-month expectation, and the company is ranked as a strong buy, coming in at a 1.8. So another company that analysts are loving right now, and what we saw so far is that every single stock we've discussed is trading below their 12-month price target, and they're all ranked as a buy or a strong buy coming from Wall Street analysts. And Facebook is the same, and going forward, I think this company will continue to dominate, show very strong outperformance like we've seen over the past 5 to 10 years. And now if we move on into the 6th and final big tech company, I'm sure you know exactly what it is. It's the only giant that we haven't gone through already, and that is ticker AMZN, which of course is Amazon, the leader and the market dominant in the e-commerce world that currently trades for $3,340 per share, and they're up by 39% over the trailing 12 months. They have a market cap at $1.68 trillion and a forward PE of 70.4. And their latest earnings are coming out on April 29th. We have a revenue estimate of $104 billion with earnings per share of $9.58 and some mixed reviews over the past 90 days with 14 upward revisions and 11 downgrades. And over the past 4 quarters, the company missed once in early 2021, but has followed it up with 3 major EPS beats over the previous 4 quarters, and we're expecting a 91% growth rate in their year-over-year EPS. And right now, this company is an absolute beast with over $386 billion of total revenue in the trailing 12 months, which is absolutely incredible. And another brand that is close to triple their total revenue in a 3-year timeline. And the company is now focusing on net income as well. And over the past year, $21 billion of total profits have flown into Amazon. And this company does so much more than just e-commerce. They're a leader in artificial intelligence, different services, autonomous vehicles, and so much more. And I think this is a brand, even if you own them through a simple S&P 500 index fund, you have to have some capital into Amazon, because I think they're going to be the largest and most dominant company in the world over the next decade. And going forward, analysts are projecting 38% annual share price appreciation to come from the e-commerce giant, and at this current level, they are considered a strong buy, and that $3,340 share price is well below the 12-month expectation of right around $4,000. So a lot of implied upside over the shorter term. So we all know Amazon. I'm sure we've all used their services. The company has been growing at a tremendous rate, and that accelerated due to the 2020 pandemic. And I think going forward, most businesses are going to try to go direct to consumer through an Amazon platform because it is the market leader, it already has the customers, and I think over the longer term, the brand will continue to dominate for decades to come. So I think Amazon is still very early on, and I would not be surprised, and this is a very long out expectation, over the next 20 to 30 years, if this company grows, to be worth over $10 trillion with over, I'm going to say, $1 trillion in annual revenue and become the first company to hit that mark. Very bold prediction. That's my expectation and my guess over the long term. And I think Amazon is the company with the ecosystem to do just that. So now we're going to wrap up the video. I want to thank you for watching to the end. This was a longer one, but we went over the top 6 big tech companies who are sharing their latest earnings over this upcoming week. And because these companies are so large and they make up around 20% of the total S&P 500, if they report some bad earnings and we get some volatility, I think the overall market is going to see a lot of price movement over the next few days, creating some excellent buying opportunities. So now we're going to close it out. Please hit that like button and subscribe if you haven't done so already. I am the Gen Z Investor. I want to thank you for watching, and I will see you in tomorrow's video.